the last couple of years, we saw ESG-focused investing gaining popularity amongst financial professionals and investors across the world. We are joined today by John Duncan, Head of Responsible Investments at Old Mutual, to share some of his insights into the concept of ESG. Welcome, John.
Thank you very much for having me.
Let's start with the first question. Let's maybe explain to investors what is ESG and what is it not.
Yeah, sure. So thank you. I mean, firstly, I guess what I would say is that it's not a fad. From where we're sitting, we see it as a fundamental reorientation of the capital markets. And we think it's going to be something that will be with us forever. And it's a fundamental sort of reshaping of how the markets are. If we actually look at the acronym ESG, it stands for Environmental, Social, and Governance. We simply see it as a catch-all for everything regarding sustainability. And our view simply is sustainability is a macro thematic trend that is fundamentally reshaping the competitiveness across all industries. And that companies that can get ahead of this, ahead of their peers in the same sector, will show a whole lot of really important features, low cost of capital, better resource efficiency, low staff turnover, better access to new markets, stronger innovation, better brand trust, and in the long run, will show, sustainable competitive advantage. And it's really ESG is the catch-all acronym that's used to capture this broad range of sustainability issues. If we look in the E bucket as an example, one could look to the example of climate change as an environmental issue. From a macro thematic perspective, what does that mean for long-run decarbonization? How is renewable energy, battery technology, electric vehicles disrupting the commodity market? So ESG provides you with a lens to look into the E bucket. From the S side, one might look at issues concerning a company's health and safety practices. One might look at how they treat their staff. One might look at the social impacts of their products, the quality of trust, etc. in the organization, and one might review that relative to peers and see whether it's being effectively priced. And then the last, the G bucket, governance, we all understand what that means. And we have all, I would argue, in the South African market, experienced the consequence of poor governance. So ESG is just a useful acronym for categorizing sustainability issues. But what is ESG? It's an acronym that points towards sustainability issues. But above that, at a meta level, we believe it's a fundamental reorientation of the capital markets towards a growth path that needs to be low carbon, resource efficient, and socially inclusive.
Thank you. So you mentioned now ESG, the acronym. Do you think in South Africa there's a specific focus on either the E and the E, S and the G, or is it a focus on all three of them?
I would say that historically there's been a very strong focus on governance, and that's not without reason. Broadly across the markets, the focus has been at a governance level. Just that's now from an investment perspective. If you think about what are the most pressing issues contextually for the South African economy, they are undoubtedly sit in the social bucket. Poverty, inequality, unemployment. These are issues we have to fix if we want to have a stable economic growth path as an economy. But at the same time, we shouldn't forget the environmental bucket. South Africa is exposed to the long run impacts of a changing climate. And so, while social issues might be primary, certainly environmental issues are an amplifier of those social risks. So I would say increasingly the lens and its application in the domestic market to the domestic counters is growing from a G perspective to include both social and environmental issues.
Okay, well, that makes sense. So one of the myths, I think, amongst investors, when you talk about ESG investing, is that you have to sacrifice performance. Would you agree with that?
No, I won't. I wouldn't agree with that. Simply because, our perspective is that, considering ESG issues is not an automatic haircut on your returns. We would argue the opposite, that actually properly applied ESG issues can be additive to returns. And look, simply because a company says or a fund says it's doing ESG practices or it's integrating these issues in the investment process doesn't mean that you're automatically going to get outperformance. But applying ESG and applying it well can be additive, and it certainly doesn't, from our perspective, harm returns. I just want to show you slightly a performance chart of an ESG index, which we've been running for some time. It's the ESG index for emerging markets. What I would like to do, just to give you an example from a performance perspective, what I'm sharing with you now is the MSCI ESG index. This is an index that's designed to have relatively low tracking error against the MSCI Emerging Market Index. The fund selects the top 50% or so of performers from an ESG perspective when the companies are selected within the same sector. So the top companies from an ESG perspective in the auto sector are selected. And what you can see is a very sort of clear outperformance signal over time. Our view simply is that ESG is a proxy measure for management quality. And given what we know about the emerging markets, in the sense that regulation around ESG issues is typically poor, our view is that company management that are doing these issues well, managing ESG issues well, are typically managing a lot of other issues voluntarily well as well. And simply, we see it as a proxy measure for good quality. And that's partly what we think explains the outperformance over time. And as you can see, it's very consistent, dating all the way back through to 2009. So a very long time series of performance, and certainly something that provides, I think, a very tangible, real example of why this myth around ESG being harmful to performance doesn't always necessarily hold true.
Yeah, that makes sense. So from an investor point of view, John, do you think an investor get the benefit from buying a product specifically labeled ESG, or can one get that benefit by selecting a fund that's available to all investors with a very strong focus on those ESG principles?
That's a great question. I think what's true to say is that ESG, or responsible investing, which is the commitment to voluntarily integrate ESG issues into your investment process, both in terms of research, security pricing, portfolio construction, as well as stewardship, how you vote and engage with the company. That voluntary responsible investment commitment, I would argue that there's almost no fund manager in South Africa that's not going to be saying they're doing that. And to a large extent, what they've done is they've retrofitted this ESG lens into their investment process. And to the extent that that's been well considered, and the fund itself is orientated towards capturing the opportunity set and reflecting that in their portfolio, then buying a normal fund with a good set of ESG integration practices and a clearly defined investment strategy around pursuing sustainable returns, if you do your due diligence well and you understand what you're looking at, I think selecting a fund with that approach may well be additive or supportive of your desire to get returns. On the other hand, what we're also seeing of new funds that are designed from the ground up, where the desire to achieve mandated ESG outcomes along with returns is hard-coded into the fund mandate. And what we're starting to see is an increasing amount of standardization of product labeling. If we refer, for example, from a fund labeling perspective to what's happening in Europe, they recognize that there is an element of greenwashing, and we need to be very alive to that in the market. And so they've gone through a process of standardizing the sustainability disclosure criteria for funds. And I would say that funds that have got, meeting those, transparent labeling criteria and have hard-coded ESG outcomes, certainly investors can get comfort that they're both getting returns plus a mandated ESG impact or outcome. That might be by way of a delta to the benchmark. So you could have a positive or a negative carbon delta to a benchmark, or you could have a measurable overall ESG quality score improvement versus a benchmark. And so, where funds are labeled around those criteria and they're visible and they follow international standards, certainly the buyer could get comfort from that kind of labeling. But I just also want to say this, just because a fund's labeled ESG doesn't mean that it's going to outperform, and one has to be alive to greenwashing. So, I would just kind of caution people around that.
Yeah. So back home, John, in South Africa, there's a big drive from the FECA, specifically in the institutional space, to sustainability of future investments. So sustainability can mean many things, but is it possible to quantify or qualify that measurement in the local market?
Yeah, so it's a really interesting question. I mean, sustainability. Let's just pause for a second and reflect on what that is. Sustainability is the science of complex systems. Sustainability in our world means the interaction between the market, society, and the environment. We know that what happens in the market has negative impacts on the biophysical system, and we know that if the biophysical system fails, societies fail and the markets fail. And so
Mm,
this drive that the FSCA has in the institutional space makes good sense because you're dealing with funds that have got 10 to 20 to 30-year liability horizons. And certainly from their perspective, it does not make sense to drive an investment culture which pursues short-term returns, but fundamentally erodes the quality of the systems we're going to need to survive on in the future. So when the FSCA is talking about sustainability, they are, pushing the institutional long liability investment horizon kind of community to say, consider these unpriced externalities in the way you invest today and help us move towards a low carbon, resource efficient, socially inclusive outcome. Now, your question is, how do you measure that in the context of the listed markets? Now, firstly, what I would say is that if you think about the South African market specifically, and you think about sustainability in the long run, uh, the investment thesis holds true when you think, does this company manufacture its revenue through the production of a good or a service that's aligned with green economy outcomes? And when we look at where those opportunities sit in the South African economy, the bulk of those sit in the private market space. So if you want to
mm,
invest in schools or renewable energy or agriculture, or banking the unbanked. There's a handful of companies in the listed space which give you those opportunities, but the bulk of the net positive sustainable contribution type investment opportunities are in the private market space. So shifting gear to the listed markets, when one thinks about impact on sustainability, one can think about it in terms of net positive contribution, which you're going to
mm,
get in the alternatives environment, or you can think about harm reduction. So in the listed space, typically, and I mentioned this earlier, you can think about impact as a measurable delta to a benchmark. So for example, if you are wanting and you have a thesis about the long run decarbonization of economic growth globally, and you're wanting to have a measurable fund that tracks that uh, carbon reduction, it is possible to calculate the weighted average carbon intensity of the CAPSWIX, and it is possible to buy a fund in the market. In fact, we have one that is 40% less carbon intensive. And so there's a
mm.
sustainability measure, it's an impact measure, it's in the fund mandate, and we can report it. Similarly, we are innovating and designing a whole range of other impact metrics, whether they are on transformation, gender diversity, water intensity, and the like. Um, so it is possible to measure some of these attributes of sustainability, but it is in quite a very narrow band in the listed markets, and it's always going to be referenced against a benchmark. Does that make
Thank
sense?
you. Yeah, it makes perfect sense. Thanks for joining us, John. But I do understand that it's a very comprehensive topic and one can talk hours about this. But thank you for sharing your insights into some of the questions that we get from investors on this topic.
Yeah, thanks very much. I mean, just in closing, I would say that, this is a topic that's relevant to both the end consumer, the buyer of financial products, as well as the seller of financial products. And so our experience is that consumer trends, particularly across the upper LSM categories, is tilting towards more sustainability aligned goods and services. And we see that as quite consistent. We also know that the younger generation that's going to be hopefully inheriting wealth in the future has an interest in this topic. And so, as a financial advisor, the topic also becomes relevant in terms of your own business enterprise, in the
Mm.
sense that if this is a fundamental, permanent shift in the market, having literacy on this topic and being able to advise clients in terms of where to place their capital, I would argue that it's definitely a skill for the future.